Take a look at these charts for a second. The yield curve stayed inverted for over 700 days, and the last time it looked this extreme was right before the 1929 crash. Gold didn't just rise, it doubled past $4,000, a move that has preceded every 40 to 80% market drop in the last century. Commercial real estate, more than $1.5 trillion in loan must be refinanced by next year, 2026, at the interest rate 3 times higher than when those buildings were purchased initially. And the credit card delinquencies just hit a 14-year high, even though the unemployment is still low. Now, when you overlay all these graphs, the yield curve, gold, debt, and the delinquencies, something unusual happens. They all converge on the same timeline, mid-2026.
And you're not worried about a recession in 2026 for the US? You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement.
This is not a prediction. It's not panic. It's a pattern that has appeared before every major financial reset for 200 years. So the real question is, why are these numbers acting exactly the way they did before the biggest crashes in the history? Now, before we go further, quick reminder. Only 12% of the viewers who watch my finance tips are subscribed. Please take those 2 seconds to subscribe and make sure you don't miss out on the other 88% of the value. Alright, let's get back to the topic. Most people look at these charts separately and think they're random events. But when all of them break at the same time, it's never random. It means the financial system is sending one message repeatedly. The pressure is building underneath the surface. And this is not the first time it has happened. In every financially driven crisis, the 2000 dot-com bubble, 2008 the housing collapse, and the build-up to 2020, the cracks showed up before the headlines did. And today, those same indicators are not just flashing red, they are matching some of the most dangerous periods in financial history. But here's the twist nobody talks about. This does not mean everything collapsed tomorrow. It means the system is entering a phase where small cracks turn into a big break, and big breaks turn into opportunities that most people miss because they are busy panicking. So before we talk about preparing or profiting, you need to understand one simple truth. Recessions don't destroy wealth. They expose weak decisions and reward the strong ones. And before you assume this about predictions or fear, let me show you something far more important. What the very first real sign of 2026 recession would actually look like, and why you'd be able to recognize it months before the headlines do. The truth is, the economy always moves in cycles, not randomly, not emotionally, but in a rhythm documented by economists for over 100 years. Every cycle has 4 stages. Number 1 is growth. It is the rebuild phase after crisis, like the 1950s. Then comes the peak, which has optimism, spending, market at highs like 2021. And then comes the slowdown, where the inflation rises, growth stalls, and debt piles up like 1970s or late 1990s. And then comes the reset, when debt becomes too heavy and the system corrects like the year 2000 or 2008. Here is the key. Almost every major cycle model, Dalio's debt cycle, Kondratiev's waves, generational cycle, all cluster the next reset window around 2026. Not because anyone can predict the exact day, but because debt, inflation, credit stress, and interest rate follow the same rhythm every time. And right now, that rhythm is reaching its final beat. So what cracks first? Most people think it's the stock market. It's not. The market is just the headline. The real damage starts quietly underneath the surface. And in 2025, you can already see the usual suspects. The very first place stress shows up is household debt. Right now in the US, about 4.5% of all the household debt is in some sort of delinquencies. Serious delinquencies in credit card and student loans are rising fast. In the lowest income neighborhood, 90-day credit card delinquencies have jumped from 12% to over 20% since 2022. Now, those are not soft landing numbers. Those are late cycle pressure numbers, the kind you see when people are maintaining their lifestyle on borrowed money. The second crack usually hit lenders. In 2025, regional banks are still smiling for CNBC, but if you look at the details, office building loans now have double-digit delinquencies. Banks are quietly extending and pretending, pushing loans forward, hoping rates will magically fall. They still hold trillions in commercial real estate exposure. If refinancing falls, many loans from 2020-2021 needs to be refinanced at the triple interest rate. This is where the stress can jump from the boring footnote to front page panic. This is exactly what has happened before 2008. just in different sector. The third crack, layoffs. Since early 2025, as we know, thousands of job cuts have been announced across profitable sectors like tech, banking, retail, logistics, pharma, consulting, everywhere. Companies like Amazon announced around 14,000 corporate layoffs while still spending billions on AI and automation. And this is a classic late cycle behavior. Cut cost early, preserve margins, and protect the stock price. And this fourth warning is one indicator that almost never makes mainstream news, but historically screams when the system is under stress. Gold. Not because gold is safe, but because gold rises when everything else starts breaking. And in 2025, gold didn't just rise, it doubled past the 4,000 mark. And here is why it matters. Before the 2000 crash, gold began climbing quietly. Before the 2008 crisis, it surged months before banks collapsed. And right now, we are seeing the same pattern again. Gold at $4,000 doesn't mean panic. It means the global financial system is under pressure, and the big institutions, not retail investors, are hedging the risk early. Which brings us to the real question. How do regular people like you and me protect themselves when the cycle turns, and how do they avoid being the ones caught in the reset? Let's take a break here. Recessions don't punish prepared people. They punish people who react. So let me show you exactly how you prepare for 2026 without fear, without trying to time the market or predict anything. But if you're interested in more personal finance insight, then please subscribe to this channel. Alright, the first step you can take is strengthen your cash flow first. Now, before you think about investments, think about your household engine. Number 1, trim your lifestyle creep. Number 2, delay big discretionary updates. Then lock in stable money expenses. Then you can build a small buffer of 3 to 6 months. Because when layoff hit and AI is reshaping the white collar jobs, cash flow is your oxygen. If you can breathe comfortably, you won't panic sell your investments. Number 2, don't stop your dollar cost averaging ever. If 2026 turns into a reset year, biggest mistake people will make is stopping their investments right when the long-term opportunity begins. Dollar cost averaging is designed for times like this. During crashes, the same dollar buys you more shares. The people who kept buying in 2001, in 2008, in 2020 are the ones sitting on the biggest gains today. Recessions are not when you stop investing. They are when your future self is begging you to stay consistent. Number 3, avoid new debt, especially the high interest debt. A recession exposes anyone who took on credit card debt, big car payments, buy now, pay later shopping, lifestyle purchases funded by credit. The rule is simple. If you can't pay it off in 30 to 60 days, don't take it. Debt removes your ability to stay calm, and cash gives you that flexibility, and debt gives you stress. Number 4, strengthen the job security, the new asset class. AI is replacing repetitive white-collar tasks faster than people expected. You don't need to become an AI engineer, but you do need to learn automation tools, become the efficient person on your team, understand how AI affects your industry, and you have to stay valuable, and that's how you'll be not replaceable. In a recession, raises stop, but high performers keep their job. Your career is still your strongest wealth creator. Number 5, keep some cash for opportunity season. Not all cash, just enough. Because if the market drops, great companies go on sale. Real estate you couldn't afford becomes affordable. Bitcoin and gold becomes volatile but creates great entry points. And index funds gives you 20 to 40% discounts. You don't need $100,000 sitting idle. Even 5 to 10K can change your financial life when you deploy it at the right moment. Crashes are scary only when you are not ready for them. And number 6 is be diversified. This is where gold, Bitcoin, and is the dollar dying conversation comes in. The truth is, no, the dollar is not disappearing tomorrow. No, the Bitcoin is not replacing all fiat currencies overnight. And no, the AI is not eliminating all your jobs. But small diversification helps. Put 90% in the stocks, bonds, REITs, and index funds, maybe 5 to 10% in alternatives like gold and Bitcoin. Not because you are trying to predict anything, but because diversification protects you against the unknown. Here's the part most people misunderstand about recession. Markets don't stay low forever. Every major downturn, take it 2001, 2008, 2020, snapped back faster than anyone expected. And the people who benefited were not the ones who predicted it perfectly. They were the ones who simply stayed invested. Your goal is not perfection. Your goal is preparedness. Stay liquid, stay employed, stay diversified, and keep investing. That simple system beats timing, fear, and guessing the Fed every single time. The biggest wealth creation happens after the reset. After 2008, the S&P 500 tripled. After 2020, the tech exploded. Recessions feel scary only in the moment, but history is clear. The years after the crash create more upward mobility than the boom that came before. Preparations will protect you. Consistency builds wealth, and the reset isn't the end. It's the beginning of the opportunity most people will miss. That's it for today. If you want to keep improving your finances, just hit that subscribe below and share this video with your friends and family. Your finance friend Sushant, signing off.